Welcome. Today, we're diving into a question that's on many homeowners and investors' minds. What happens to your money if the housing market crashes? Whether you own a home, are thinking about buying, or simply want to understand how your finances could be affected, this video will break down the key impacts of a housing market crash. We'll explore what a crash means, how it affects property values, mortgages, investments, and your overall financial well-being. Let's start by understanding what a housing market crash actually is. A housing market crash refers to a sudden and significant drop in home prices across a region or even an entire country. This usually happens when there's an economic downturn, a burst of a housing bubble, or a sharp increase in interest rates. During a crash, the demand for homes falls, leading to lower prices and longer selling times. Understanding this definition is crucial because it sets the stage for how your money, whether invested in property or tied up in a mortgage, could be impacted. Next, let's look at how your home's value might change. When a housing market crash occurs, the most immediate effect is a drop in home values. If you own a home, its market price could decrease, sometimes dramatically. For example, a house worth $400,000 before the crash might only fetch $300,000 or less afterward. This doesn't mean you lose money instantly, but the equity you have in your home, the difference between what you owe and what it's worth, shrinks. This can be unsettling, especially if you were counting on your home's value for future plans. Let's see how this affects your net worth. Your net worth is the total value of your assets minus your liabilities. For many people, their home is their largest asset. When home prices fall, your net worth decreases because the value of your biggest asset drops. If you have a mortgage, the amount you owe stays the same, but your home's value may fall below what you owe. This situation is called being underwater on your mortgage. It's a tough spot, but it's important to remember that these losses are only on paper unless you sell during the downturn. Next, let's talk about mortgages. If you have a mortgage, a housing crash can be particularly stressful. Even if your home's value drops, your mortgage payments stay the same. If your home's value falls below your mortgage balance, you're considered underwater. This can make refinancing or selling your home difficult without taking a loss. However, as long as you keep making payments, you can stay in your home. The real risk comes if you need to move or can't afford payments. Let's look at what happens if you're forced to sell during a crash. If you need to sell your home during a housing market crash, you might have to accept a much lower price than you expected. This could mean selling for less than you owe on your mortgage, resulting in a loss. In some cases, homeowners may need to bring extra money to the closing table just to pay off the mortgage. This is a tough situation, but it's important to know your options, such as negotiating with your lender or considering a short sale. Next, let's discuss what happens if you don't sell. If you're able to stay in your home and keep making mortgage payments, you may be able to ride out the downturn. Housing markets are cyclical, and values often recover over time. While your net worth may be lower on paper, you don't actually lose money unless you sell at a loss. For many homeowners, patience and the ability to wait for the market to recover is key. Let's now look at how a crash affects real estate investors. Real estate investors face unique challenges during a housing market crash. If you own rental properties, falling home values can reduce your equity and make it harder to refinance or sell. Rental income might also drop if tenants struggle financially. However, some investors may find opportunities to buy properties at lower prices. The key is to have a long-term strategy and enough cash reserves to weather the downturn. Next, let's talk about what happens to your investments in real estate funds, or REITs. If you've invested in real estate investment trusts, REITs, or real estate funds, a housing market crash can cause the value of your shares to fall. These funds often own a mix of properties, so their performance is tied to the broader real estate market. During a crash, share prices can drop quickly, and dividends may be reduced. However, just like with physical property, these losses are only realized if you sell your shares during the downturn. Let's move on to how a crash affects the broader economy. A housing market crash doesn't just affect homeowners and investors. It can ripple through the entire economy. Construction slows down, related industries like furniture and appliances see less demand, and consumer confidence drops. This can lead to job losses and reduced spending, which in turn can make the downturn worse. Understanding these broader effects helps explain why housing crashes are taken so seriously by governments and central banks. Next, let's see how banks and lenders are affected. Banks and lenders are at risk during a housing market crash because more homeowners may default on their mortgages. When property values fall, banks may not be able to recover the full amount owed if they have to foreclose and sell the home. This can lead to tighter lending standards, making it harder for people to get new loans. It's a cycle that can further depress the housing market. Now, let's talk about what happens to your savings and cash during a crash. If your money is in a savings account or cash, a housing market crash doesn't directly affect it. Your cash remains safe, especially if it's in an FDIC-insured bank account. However, if the crash leads to a broader economic recession, you might see lower interest rates on savings and potential inflation. It's important to keep your emergency fund intact during uncertain times. Next, let's look at what happens to your retirement accounts. If your retirement accounts are invested in real estate or related funds, their value may drop during a housing crash. However, if your portfolio is diversified, the impact may be less severe. Stocks, bonds, and other assets can help balance out losses in real estate. The key is not to panic and avoid making rash decisions. Retirement savings are for the long term, and markets often recover over time. Let's discuss how to protect your money during a crash. To protect your money during a housing market crash, focus on diversification and maintaining a strong emergency fund. Avoid putting all your assets into real estate. Keep some savings in cash or low-risk investments. If you own a home, try to avoid selling during a downturn unless absolutely necessary. Staying informed and planning ahead can help you weather the storm. Next, let's look at how first-time buyers are affected. For first-time homebuyers, a housing market crash can be both a challenge and an opportunity. On one hand, falling prices may make homes more affordable. On the other, tighter lending standards and economic uncertainty can make it harder to qualify for a mortgage. If you're considering buying during a downturn, make sure your finances are strong and you're prepared for potential price fluctuations. Let's now discuss the psychological impact of a crash. A housing market crash can take a toll on your mental well-being. Watching your home's value drop or worrying about your financial future can cause stress and anxiety. It's important to remember that markets are cyclical and downturns are often temporary. Staying focused on your long-term goals and seeking support from financial professionals can help you manage the emotional side of a crash. Next, let's talk about government intervention. During a housing market crash, governments and central banks often step in to stabilize the market. They may lower interest rates, provide financial assistance to homeowners, or introduce programs to help banks and lenders. These measures can help slow the decline in home prices and restore confidence. However, recovery can still take time. Let's see how long it typically takes for markets to bounce back. The time it takes for the housing market to recover after a crash varies. In some cases, it can take several years for home values to return to their previous levels. Recovery depends on factors like economic growth, job creation, and consumer confidence. While waiting for a rebound can be frustrating, history shows that markets do eventually recover. Let's look at some lessons from past housing crashes. Looking back at previous housing market crashes, such as the 2008 financial crisis, we see that patience and preparation are key. Homeowners who avoided panic selling and kept up with their mortgage payments often saw their home values recover over time. Diversification and maintaining a healthy emergency fund also helped many people weather the storm. These lessons can guide your decisions if another crash occurs. Next, let's discuss the risks of foreclosure. If you're unable to make your mortgage payments during a housing crash, you risk foreclosure. This means the bank can take possession of your home and sell it to recover the loan balance. Foreclosure can severely damage your credit and make it difficult to buy another home in the future. If you're struggling, reach out to your lender early to discuss options like loan modification or forbearance. Let's now look at how renters are affected by a crash. Renters are not immune to the effects of a housing market crash. If landlords face financial trouble or foreclosure, tenants may be forced to move. On the other hand, falling home prices can make renting more attractive compared to buying. Rental prices may also fluctuate depending on local supply and demand. It's important for renters to stay informed and have a backup plan in case their housing situation changes. Next, let's discuss the impact on property taxes. A drop in home values can eventually lead to lower property taxes, but this doesn't happen overnight. Local governments reassess property values periodically, so it may take a year or more for your tax bill to reflect the new, lower value. In the meantime, you may still be paying taxes based on the old, higher value. Let's now look at how insurance is affected during a crash. Home insurance premiums are generally based on the cost to rebuild your home, not its market value. So even if your home's value drops, your insurance costs may not decrease. However, if a crash leads to fewer claims or less risk in your area, you might see some savings. It's always a good idea to review your policy and shop around for better rates. Next, let's talk about home improvement and renovation plans. During a housing market crash, many homeowners put renovation or improvement plans on hold. With home values falling, it may not make financial sense to invest in upgrades that won't increase your property's value. If you do decide to renovate, focus on essential repairs rather than luxury upgrades. This can help maintain your home's condition without overspending. Next, let's discuss the impact on home equity loans. A housing market crash can make it harder to get a home equity loan or line of credit. Lenders may reduce the amount you can borrow or tighten approval standards. If your home's value drops significantly, you may not qualify for additional borrowing at all. It's important to avoid using your home as an ATM, especially during uncertain times. Let's now look at the risks of negative equity. Negative equity occurs when your home is worth less than the amount you owe on your mortgage. This is a common risk during a housing market crash. Negative equity can make it difficult to sell or refinance your home. If you're in this situation, focus on making your mortgage payments and avoid taking on more debt. Over time, as the market recovers, your equity position may improve. Next, let's discuss the importance of credit scores. Your credit score can be affected if you miss mortgage payments or go through foreclosure during a housing crash. A lower credit score makes it harder to get loans or favorable interest rates in the future. Protect your credit by making payments on time and communicating with your lender if you're struggling. Good credit is an important asset, especially during tough economic times. Let's now look at how to prepare for a potential crash. Preparation is key to minimizing the impact of a housing market crash. Build up your emergency savings, avoid taking on too much debt, and keep your finances organized. If you're considering buying a home, make sure you have a stable income and a solid down payment. Being prepared can help you weather the storm and take advantage of opportunities when the market recovers. Next, let's discuss the importance of financial advice. If you're unsure how a housing market crash could affect your money, consider speaking with a financial advisor. Professionals can help you review your finances, create a plan, and make informed decisions. They can also help you understand your options if you're facing financial hardship. Don't hesitate to seek guidance. It can make a big difference in your financial security. Next, let's look at how to spot warning signs of a crash. There are several warning signs that a housing market crash may be coming. These include rapidly rising home prices, increasing mortgage defaults, and a slowdown in home sales. Pay attention to economic indicators like unemployment rates and interest rate changes. Being aware of these signs can help you make better financial decisions and prepare for potential downturns. Next, let's discuss the role of interest rates. Interest rates play a major role in the housing market. When rates rise, monthly mortgage payments become more expensive, which can reduce demand for homes and trigger a downturn. Conversely, lower rates can stimulate buying. Understanding how interest rates affect the market can help you make smarter decisions about buying, selling, or refinancing. Let's now look at the impact on home builders and construction. A housing market crash often leads to a slowdown in new construction. Homebuilders may delay or cancel projects due to falling demand and lower prices. This can impact jobs in construction and related industries. If you work in these fields, it's important to be prepared for potential job instability during a downturn. Next, let's discuss the impact on local communities. A housing market crash can affect entire communities. Falling home values can lead to reduced property tax revenue, which may impact funding for schools, public safety, and local services. Vacant homes and foreclosures can also hurt neighborhood stability and property values. It's important for communities to work together and support each other during tough times. Next, let's look at the global impact of a housing crash. Housing market crashes in major economies can have global effects. International investors may pull back, and financial markets can become more volatile. Countries with close economic ties may also feel the impact through reduced trade and investment. Understanding the global nature of real estate markets can help you see the bigger picture and prepare for broader economic shifts. Next, let's discuss the importance of patience during a downturn. One of the most important lessons during a housing market crash is to be patient. Markets are cyclical, and downturns are usually followed by recoveries. Avoid making impulsive decisions based on fear. Focus on your long-term financial goals and remember that time in the market often beats timing the market. Let's now look at some practical steps you can take if a crash happens. If a housing market crash occurs, review your finances and make a plan. Cut unnecessary expenses, boost your emergency savings, and avoid taking on new debt. If you're struggling with mortgage payments, contact your lender early to discuss options. Stay informed about market trends and government programs that may offer assistance. Taking proactive steps can help you navigate the downturn more confidently. Next, let's discuss the importance of staying informed. Staying informed is crucial during a housing market crash. Follow reliable news sources, track local market trends, and stay in touch with financial professionals. The more you know, the better prepared you'll be to make smart decisions. Don't let rumors or panic drive your actions. Focus on facts and expert advice. Next, let's look at the role of technology in today's housing market. Technology has changed how we buy, sell, and track real estate. Online listings, virtual tour, and digital mortgage applications make it easier to navigate the market, even during a downturn. Use technology to stay updated on home values, interest rates, and available properties. Embracing digital tools can help you make more informed decisions and spot opportunities in a challenging market. Next, let's discuss the importance of community support. During tough economic times, community support can make a big difference. Neighbors, local organizations, and support groups can provide resources, advice, and encouragement. Don't hesitate to reach out if you need help, and consider offering support to others in your area. Strong communities are better equipped to weather downturns and recover together. Next, let's look at the importance of mental health during a crash. Financial stress during a housing market crash can affect your mental health. It's important to take care of yourself, seek support if needed, and maintain healthy routines. Don't hesitate to talk to friends, family, or professionals about your concerns. Remember, you're not alone, and many people are facing similar challenges. Next, let's discuss the importance of setting realistic expectations. During a housing market crash, it's important to set realistic expectations for your finances and property values. Understand that recovery may take time and that short-term losses don't define your long-term financial health. Adjust your plans as needed and stay flexible. Being realistic can help you avoid disappointment and make better decisions. Next, let's look at the value of long-term planning. Long-term planning is essential for financial stability, especially during uncertain times. Focus on building wealth gradually, maintaining good credit, and keeping your debt manageable. Set goals for savings, retirement, and homeownership that account for market ups and downs. A solid long-term plan can help you stay on track, no matter what happens in the housing market. Next, let's discuss the importance of adaptability. Being adaptable is crucial during a housing market crash. Markets can change quickly, and being willing to adjust your plans can help you make the best of a tough situation. Whether it's delaying a move, rethinking investments, or finding new ways to save, adaptability can help you stay resilient. Let's now summarize the key takeaways from today's discussion. To wrap up, a housing market crash can impact your money in many ways, from home values and mortgages to investments and mental health. The most important things you can do are to stay informed, plan ahead, and avoid panic. Diversify your assets, maintain emergency savings, and seek professional advice if needed. Remember, downturns are temporary, and with patience and preparation, you can protect your financial future. Let's finish with a quick summary. Thank you for joining us to explore what happens to your money if the housing market crashes. While a downturn can be challenging, understanding the risks and preparing in advance can help you navigate uncertainty with confidence. Remember, markets recover, and your financial well-being depends on smart planning and resilience. Stay positive, stay prepared, and take care of yourself and your finances.